Welcome to the Deep Dive, where we take a stack of sources and uncover the most important insights for you.
Yeah, that's what we do.
Today, we are plunging into the recent financial performance and outlook for Core and Maine. They're a major player in water infrastructure distribution.
That's right. We've got their Q1 2025 earnings report right here and the full transcript of their earnings call too.
Yeah.
So all the details, everything we're discussing, it's coming straight from what the company put out.
And our mission. Pretty straightforward, really. We want to unpack these numbers, try to understand the actual market dynamics Core and Maine is seeing out there, and figure out what's really driving their business right now.
Yeah.
And here's the interesting bit, the hook for this deep dive.
Right.
They reported, well, pretty solid results. Revenue beat expectations, earnings matched targets, profitability looked decent.
Good, yeah.
But then the stock price, it actually saw a slight dip right after the news.
Right. A little counterintuitive.
Exactly.
Yeah,
So that's kind of the puzzle we want to tackle.
definitely. We'll guide you through the key financial takeaways, look at what their leaders are saying about the market, the environment they're in.
And the analyst questions too, right?
Oh, yeah, absolutely.
Yeah.
Explore some of those questions analysts were asking on the call because, well, those often show you where the market's really focused, maybe where the concerns are.
Okay, let's dive in then. Start with that financial snapshot for Q1 2025. What were the headline numbers that jumped out at you?
Well, right at the top, net sales came in at $1.9 billion for the quarter.
Okay.
That was actually about $6 million higher than what analysts expected. They were looking for around $1.85 billion.
So a beat on the top line, about what, 3.2% or so?
Yeah, roughly 3.24% above forecasts.
Yeah.
A pretty respectable beat.
Nice start on revenue. How did that flow through to profit?
Well, looking at earnings per share, EPS, they reported 52 cents.
Okay.
That was exactly what analysts forecasted, spot on. And it was up 6% compared to the same quarter last year.
Okay, matching expectations there with growth.
And their adjusted EBITDA, that's a key measure for them, operational profitability, that was $224 million, also showing an increase 3.2% year over year.
So top line beat, bottom line met and grew. What about gross profit in those margins? That's often where you see the story about pricing and costs, right?
Exactly. Gross profit was strong, $510 million, which is up a healthy 9% year over year.
9%, wow.
Yeah. That gave them a gross margin of 26.7%. Now,
Okay, 26.7, how does that compare?
well, that margin was actually down just a tick from 26.9% in Q1 last year.
Ah, okay.
But importantly, it did improve sequentially compared to the previous quarter, Q4 2024.
Right, so better than last quarter, but slightly down from a year ago. Did they say why?
They did. The explanation for that year-over-year dip was mainly a higher average cost for their inventory this year compared to last year.
Inflation, maybe, or mix?
Could be. But they said this was partially offset by, their own operational initiatives and also the positive impact of acquisitions they made.
Okay, so they're managing costs, trying to integrate those new businesses to kind of counter that inventory cost headwind. Makes sense.
Yeah.
How about operating income and the final net income figure?
Operating income was $171 million, up 1.8%. Net income was $105 million, up 4%.
Okay.
And then there's this other line, net income attributable to Core and Maine, Inc. That's really the piece that matters most directly to the public shareholders.
Right.
It was $100 million, and it was up 5.3%.
So wait, there's a slight difference there. $105 million total net income, but $100 million attributable to Core and Maine, Inc. Why the gap?
Ah, yeah, that difference, it comes down to their corporate structure, something called non-controlling interests.
Okay.
Basically, without getting too deep in the weeds, it just means there are other parties with an economic stake in certain parts of the business.
Gotcha.
But the positive takeaway here, actually, is that the decrease in how much was allocated to those non-controlling interests this year compared to last year, well, that actually boosted the portion of net income flowing to the public shareholders.
I see. So that structural detail actually worked in favor of the public company's numbers this time.
Exactly.
And that feeds directly into the EPS calculation.
Precisely. You take that higher net income attributable to Core and Maine, Inc., combine it with a lower share count because they've been buying back stock.
Ah, the buybacks.
Right. And that's what drove the increase in basic EPS to 53 cents, up from 49 cents last year, and the diluted EPS to 52 cents, also up from basic 49 cents.
Yeah, share buybacks definitely help juice the EPS when net income's already growing, makes the per share numbers look even better.
Absolutely.
Standard playbook. Anything else from the core financials we should touch on?
Just maybe a quick note on taxes. Their effective tax rate ticked up a bit, 25.5% this quarter versus 24.6% last year.
Okay. Why the increase?
They said it was primarily due to that decrease in non-controlling interest ownership we just talked about. Basically, it shifted more of the total net income into parts of the company's structure that are subject to corporate tax.
Got it. So more profit flowing to the taxable part of the entity. Makes sense. All right. So summing up the numbers, they seem pretty positive, right? Revenue beat, earnings met targets and grew year over year, profitability up.
Yeah, on the surface, looks like a solid quarter.
Which brings us right back to that initial puzzle, let's call it the curious case of the stock reaction.
Yeah.
Because despite all this seemingly good news, the sources noted the stock price actually saw a pre-market decline, only 0.57%, trading around $58.99, but still a decline.
This is precisely where it gets interesting, isn't it? Because, you'd typically expect numbers like that to get at least a little positive bump.
You would.
Now, it's important context, as the sources point out. The stock is still pretty strong overall. It was trading near its 52-week high of around $60.38. So maybe this was just a small dip in the grand scheme of things, shows overall resilience.
Still, though, a dip after beating revenue and hitting earnings. What might be going on there? What did the sources suggest?
Well, the materials suggest it could be linked to sort of broader cautious market sentiment. Maybe influenced by wider economic trends or maybe sector-specific worries.
Okay.
Another possibility is just that. Well, the results were good, but maybe they weren't significantly better than what the market had already baked in, priced in to the stock value leading up to the report.
Right. The expectations game.
Exactly. Investors might have been looking for, I don't know, an even stronger outlook, maybe, or a much larger beat to justify pushing the price even higher from where it already was.
It's such a powerful reminder for you, the listener, isn't it? That a stock's reaction isn't just a simple thumbs up or thumbs down on the past quarter.
Not at all.
It's often much more about whether those numbers, and maybe more importantly, the future outlook, actually exceed what the market was already expecting.
Absolutely. It forces you, like us, to look beyond just the headlines and really dig into the underlying business trends, the market sentiment, all that stuff.
Which is exactly where we need to go next. Let's dig into the business itself. Core and Main's end markets, how different product lines performed, how do they break down their business exposure?
Okay, so based on their last full fiscal year, 2024 sales, their exposure is roughly 42% municipal projects.
Okay, the biggest chunk.
Yeah. Then 38% non-residential construction and about 20% residential construction.
Right. So that municipal piece, 42%, how is that market holding up, according to them?
They describe it as steady, stable, and, quote, notably resilient.
Okay, sounds positive.
Yeah, they really emphasize that funding is healthy, and it's coming from different places. The majority is from local utility rates, which is pretty reliable.
Right.
But there's also state-level funding, and importantly, they're seeing an increasing flow of money from the Infrastructure Investment and Jobs Act, the IIJA.
The infrastructure bill money.
Exactly. The CEO explicitly said they're strategically positioned to benefit from these, long-term secular drivers in water infrastructure spending.
Makes sense.
And the CFO added they see a growing pipeline of shovel-ready municipal projects. Gives them confidence.
Now, wasn't there some news recently about a pause related to IIJA funding? Did that come up?
Yes, it did. The sources mentioned that. An executive order back in January 2025 did pause some IIJA funding disbursements.
Okay.
But, and this is crucial for Core and Main, the company clarified that this specific pause was not related to the funding streams for their core water or road projects.
So not their main areas.
Exactly. That's central to their business. They seem to view the pause as temporary. And while, sure, a permanent change could be negative, their current outlook doesn't really suggest a big impact on their core municipal work.
Okay, good clarification there. So municipal looks strong, stable. What about the residential side? That's about 20% of their business, you said?
Yeah, residential. So that market was resilient earlier, but they are now seeing signs of softening.
Okay, why?
They link it mostly to broader economic conditions, affordability pressures, interest rates, home prices. It's causing some developers to pull back a bit, maybe reduce the scope of projects, reduce footprints was the term used.
Right.
However, they did say they still feel pretty confident about the long-term fundamentals for U.S. housing. They expect pent-up demand to eventually be released, maybe as interest rates moderate down the line.
So near-term softness, but longer-term optimism.
Kind of. And a key point the CEO made was that because residential is only about 20% of their overall business, this current slowdown, well, it isn't considered a significant driver for core and main overall.
Okay, so it's a headwind, definitely, but maybe not big enough to completely derail the company's performance, given their business mix.
That seems to be their take on it. Yeah.
And the non-residential piece, 38%.
They said their diversified mix within non-residential provided stability. Dynamics might shift between different types of projects in that sector, but overall, the segment held up okay.
All right, let's dig into the products then. How did the different categories actually perform? What stood out year over year in sales changes?
Okay, so pipes, valves, and fittings, that's their biggest category, saw a solid 10.9% increase. They said that was driven by both volume and acquisitions.
10.9, okay.
Very good. Yeah. But the real star performer was storm drainage. That had the strongest growth, up 16.6%.
Wow, 16.6% in storm drainage. What's driving that?
Well, a few things. M&A activity helped, but also the boost from road and bridge work, which, again, benefits from those IIJA funds.
Makes sense.
And they mentioned a sort of strategic shift where they're distributing these products more directly, whereas historically maybe they were handled differently, like through concrete product channels.
Interesting.
And they see storm drainage continuing to be a strong growth driver going forward.
Yeah, that storm drainage growth really clicks with the whole infrastructure narrative. How did fire protection and meter products do?
Right, so fire protection sales actually declined 9.0%.
Oh, down 9%. Any reason given?
Yeah, primarily due to lower end market volumes in that space and also some lower selling prices.
Right.
Acquisitions did partially offset that decline, but still down overall.
Oh, wait.
Meter products, though, that was another strong spot, up 9.9%.
Nice.
And what's really impressive there is that this 9.9% growth is built on top of, get this, 30% growth in the prior year's quarter.
Whoa, 30% last year. So this is continued strength.
Massive two-year trend, yeah. They said it's largely volume-driven from winning big contracts, especially for smart meters.
Ah, the smart meter transition.
Exactly. They're actually investing in technical resources specifically to help larger metro areas adopt that smart meter technology, which can be, a complex switch.
I bet.
They also noted there might be potential for price increases in meters because of tariff impacts.
Okay. It's really fascinating to see that push and pull across the categories, isn't it?
Yeah, definitely.
Strong growth in areas tied to infrastructure spending and maybe tech adoption like storm drainage and meters.
Right.
While something like fire protection faces headwinds, this product mix breakdown, it gives you a much clearer picture of where their growth is actually coming from.
Absolutely. It really highlights their leverage to, public infrastructure spending on one hand and technology adoption like smart meters on the other.
Okay, let's shift gears a bit. Operations and strategy. Inventory was mentioned earlier as impacting margins. What's the strategy there? Why did it increase?
Right, inventory levels. They increased from about $908 million at the start of the fiscal year to nearly $1.1 billion, $1.069 billion to be precise at the end of Q1.
That's a decent jump.
It is. And the company gave two main reasons for this buildup. First, they said they have confidence in their expected sales volumes for the first half of the year.
Okay, anticipating demand.
Yeah. And second, they're proactively bringing in some extra inventory because of uncertainty around potential tariffs.
Ah, trying to get ahead of potential price hikes or availability issues?
Exactly. It sounds like it's about ensuring they have the product ready for customers and also maybe mitigating potential cost increases if tariffs do change down the line.
That inventory move ties right into supply chain and pricing, which, that's been complex for basically everyone lately. What's Core and Main seeing on that front?
Yeah, they acknowledged the past disruptions for sure, but they noted sequential improvement in pricing dynamics.
How so?
Well, pricing was roughly flat in Q1 2025. That's actually a step up from Q4 2024 when pricing was slightly down.
Okay, so stabilization, maybe?
Seems like it. And their outlook for the full fiscal year is for pricing to be flat to slightly up overall.
Interesting. Is that across the board?
Not quite. They pointed out that while steel prices are improving and PVC seems stable, they do anticipate some inflation in certain other product categories.
Right, it's always a mixed bag.
Yeah, and they said their strategy here is just transparency, communicating price changes clearly with both their suppliers and their customers, trying to manage expectations.
It sounds like they're actively, juggling things on the pricing front. What about growth through physical presence? You mentioned greenfield expansion earlier.
Yes, absolutely. Opening new locations from scratch greenfields, that's a key part of their strategy, right alongside M&A.
How active are they with that?
They plan to open 5 to 10 new greenfield locations in 2025.
5 to 10, okay.
And they highlighted that these don't actually require huge capital investment to get started. And importantly, the locations they've opened since 2017, they typically become profitable within about 2 years.
That's a pretty quick payback.
It seems like it.
Yeah.
And get this, cumulatively, those greenfields they've opened just since 2017 are now contributing nearly $300 million in annual sales.
Wow. Okay, so this isn't just a side project. It's a significant scaling growth engine for them.
Exactly. The CEO sounded particularly optimistic about the potential from their greenfield pipeline.
So they're doing both, buying businesses and building their own footprint from scratch. Speaking of acquisitions, were there any significant deals in Q1?
No. The sources indicate no acquisitions actually closed in Q1 2025, which is a contrast to Q1 last year, 2024, which saw a lot of activity. Deals totaling like $585 million back then.
All right.
They mentioned that the financial impacts of those past acquisitions are now fully integrated, so they're not really tracked separately anymore.
Makes sense.
They also noted, the M&A market is competitive out there, but they feel their specific focus on the waterworks niche helps them find good opportunities.
How are they managing their core operating costs and their people? SG&A, selling, general and administrative expenses, that was mentioned as increasing.
Yeah, SG&A did increase 14% overall.
14% seems high.
It does on the surface, but they provided some helpful context.
Right.
A lot of that increase was actually due to just having a higher cost base from the acquisitions made over the past year.
Integrating those businesses costs money.
Right. And also just general inflation hitting costs. But here's the key. Organically so, if you exclude the impact of those acquisitions and also stock-based compensation, SG&A was only up approximately 4%.
Okay, 4% organic growth. That sounds much more manageable.
Yeah, and they see this organic increase reflecting underlying productivity gains. They actually expect the organic SG&A rate to improve going forward as they sort of lap or anniversary those larger acquisitions from last year.
That makes sense. Did analysts focus on that?
Oh, yeah. Analysts definitely honed in on that point during the call. They really wanted to understand the underlying cost structure and the potential for, operating leverage down the road, getting SG&A growth slower than revenue growth.
Right, right. What about the people side?
They put a lot of emphasis on their people, actually. Highlighted investments in employee training and development. They even won recognition, number 23 on Training Magazine's Global Apex Awards list.
Nice.
And they stressed having very high employee retention, which they believe is best in their industry.
That's crucial.
Yeah, and interestingly, they kind of view competitors trying to poach their employees sometimes as almost a positive signal about the quality of their team. See, our people are good.
That's one way to look at it. Okay, good to hear about the focus on people and the underlying productivity story on costs. Now, there's this topic that came up related to taxes and payments to specific stockholders, something called tax receivable agreements, or TRAs. That sounds complicated. Can you, simplify what this means for the listener?
Yeah, TRAs. They can sound pretty complex, but let me try to break it down. Here's the core idea. These agreements are basically a legacy from their corporate structure back when they went public. It involves their former private equity owners and some management folks.
Okay.
Essentially, Core & Main agreed way back when to pay these specific stockholders 85% of the tax savings that the company realizes from certain tax benefits it gets.
Okay, wait. So the company gets tax breaks, and then it has to turn around and pay 85% of those savings to these specific people.
That's pretty much it, yeah. The tax benefits themselves largely come from things related to historical transactions and also future exchanges where partnership interests in their operating entity get swapped for shares in the public company. It creates a tax shield for the public company.
Right.
And the sources show they made payments under these agreements of $18 million in Q1 2025. That was up from $11 million in Q1 last year.
Okay, so cash is going out for this. When are the payments due?
Typically, the payments are due about 2 fiscal years after the company actually uses the tax deduction on its return.
So there's a lag.
Exactly.
Yeah.
And the actual amount and timing, it depends heavily on various factors, like Core & Main's future taxable income and exactly when those partnership-to-share exchanges happen.
I see.
The sources did estimate that future payments related to potential remaining exchanges could be around $100 million over time, but again, that's just an estimate. and it depends entirely on future profits and tax situations.
So it's basically a future financial obligation that's tied to their tax structure and how well they perform. It's not cash leaving the business right now for something that happened way in the past, but it is a claim on future tax savings they generate.
That's a good way to put it. It's a claim on future tax savings.
Okay. Anything else on how they're managing the balance sheet or returning capital to shareholders?
Yeah, just briefly, they continued their share repurchase program. In Q1, they bought back $39 million worth of their own Class A common stock.
Okay. At what price?
An average price of $46.64 per share. They framed it as part of their ongoing program aimed at returning value to shareholders.
Standard stuff. Okay, we've covered the past quarter's performance, the operations, the strategy bits. Let's look ahead now. What's Core and Main's outlook or guidance for the full fiscal year 2025?
Okay, guidance. Their forecast calls for net sales between $7.6 billion and $7.8 billion,
Okay, range there.
and adjusted EBITDA between $950 million and $1 billion.
950 to a billion.
Yeah. Which suggests adjusted EBITDA margins for the full year landing somewhere in the range of 12.5% to 12.8%.
12.5 to 12.8 margin.
Yep.
Okay. What kind of assumptions are baked into that outlook?
Well, they expect to achieve volume growth. It's actually 2 to 4 percentage points higher than whatever the overall market growth turns out to be. So outperformance.
Right, share gains.
Yeah. On the pricing front, like we mentioned, their outlook is for pricing to be flat to maybe slightly positive for the full year.
Okay.
And they anticipate the overall market they operate in will be basically roughly flat for the full year.
Flat overall market. How does that break down?
They think the first half will be stronger and the second half might see a slight slowdown, mostly due to that broader macroeconomic uncertainty we talked about.
That caution in the back half, I bet analysts jumped on that.
Oh, absolutely. That was a point they really probed them on during the call. Why the caution for H2?
Makes sense, especially given the commentary on the residential market maybe softening. Are there any other, calendar quirks or comparison effects impacting the full-year outlook?
Yes, there's a key one. The fiscal calendar itself.
Ah, the 53rd week thing?
Exactly. Fiscal year 2025 has 52 weeks, but fiscal year 2024 had 53 weeks.
Right, that happens sometimes.
So that extra week in the prior year, it creates about a 2 percentage point headwind for total sales growth comparisons this year.
2 points just from the calendar.
Yeah, and it primarily impacts the fourth quarter comparison. Analysts also definitely brought this up, trying to understand the true underlying growth rate if you strip out that calendar effect.
Right, normalized for the extra week. So, okay, they're guiding for market outperformance, despite that calendar headwind and some expected softness in the back half of the year. Do they still feel confident about their longer-term margin targets? I remember they had some ambitious goals.
They do. They reiterated confidence in achieving their stated long-term goals, specifically mentioned a target of reaching a 15% adjusted EBITDA margin by 2028.
15% by 2028. That's a step up from the current 12.5, 12.8 range.
It is. They believe they have, clear strategies and levers they can pull, operational efficiencies, mix shift, maybe pricing to drive that margin expansion over the next few years.
Okay, ambition remains. Now, every business faces risks. What potential headwinds or challenges did the company highlight in their materials?
Yeah, they listed several potential risks, as you'd expect. Things like the cyclical nature of U.S. construction markets generally.
Sure.
The potential for slowdowns in municipal spending, even though, as we said, they currently see funding as healthy. It's always a risk.
Right, things can change.
The competitive landscape, obviously. Potential recurrence of supply chain issues, you never know. Regulatory changes, like that IIJA funding pause we discussed, even if it didn't hit them directly this time. They also noted exposure to interest rates, although they use swaps to help manage that. Credit risk, which they view as low because their customer base is diverse. And price risk, which they try to manage through strategy and inventory.
Anything else?
They also briefly mentioned potential product liability or litigation risk, which is pretty standard for companies dealing with physical products.
Oh, okay, standard list of business risks.
Yeah.
It's always important for you, the listener, to keep those potential challenges in mind. Now, we've touched on some analyst questions throughout, but if you were to sort of sum it up, what were the main things the market seemed really focused on during that earnings call? What were they digging into?
Yeah, looking at the transcript, the analysts were really keen to understand a few key areas.
Right.
Definitely the sustainability of those SG&A productivity gains and the potential for future leverage there.
Right, the cost control.
Yeah. Also, the degree of conservatism baked into the full-year guidance, especially given the Q1 beat. Like, are they being too cautious about the second half? Lots of questions on the detailed dynamics of pricing commodities versus finished goods. Where's the pressure? Where's the opportunity?
Okay.
The specific impact of that 53rd week in the prior year, how it affects comparisons, especially in the back half.
Yep, the calendar map.
The inventory build strategy, really understanding the rationale related to tariffs versus just demand expectations.
Makes sense.
Also, the expected severity and maybe duration of that residential construction slowdown. How bad could it get? How long might it last?
Right.
The growth trajectory in meters and storm drainage. Can they keep up that strong performance? What's the mix within meters, like smart meter adoption rates? Confidence in reaching those long-term margin targets?
Yeah.
How exactly will they get to 15%? What are the steps?
Roadmap.
Exactly. Timing of vendor price increases. When are they hitting? How are they being passed through? The strategic emphasis on greenfield expansion versus M&A. What's the right balance?
Okay.
The longer-term health of municipal funding, beyond just the immediate IIJA impact. What does the pipeline look like years out?
Yeah, sustainability.
The competitive environment for acquisitions. Is it getting harder to find good deals at good prices? And finally, how they're managing employee retention and dealing with those competitor poaching attempts we talked about.
Wow, that's quite a list. But it really gives you a sense of where the rubber meets the road for investors and analysts, doesn't it?
Totally.
They're digging into the nuances, asking the tough questions about, the durability of the performance and the potential risks ahead.
Precisely. It's all about looking behind those reported numbers to really understand the drivers, the risks, and the level of confidence management has in the future.
So wrapping this all up, what does it mean for you? Well, we've seen a company here in Core and Maine that delivered, by most accounts, a strong Q1. They exceeded revenue expectations, they met earnings targets, powered by pretty solid growth in their core areas like municipal infrastructure, and some really impressive gains in specific segments like storm drainage and meters.
Yeah, and they seem to be actively managing inventory, navigating these complex pricing environments, and strategically expanding their footprint through those greenfield openings.
Right. But despite these positive operational results, the immediate market reaction was, well, slightly negative on the day, maybe signaling some cautious sentiment out there, or perhaps just that the good news was already kind of anticipated and factored into the stock price.
Yeah, it's a powerful demonstration, really, of how looking beyond just the headline numbers is so important.
Totally.
You have to get into the detailed drivers, the specific product performance, the dynamics in each market segment, those strategic decisions around inventory and expansion, and even understanding those more complex financial structures like the tax receivable agreements. It all gives you a much richer, more, nuanced picture of a company's health and its prospects.
Absolutely. And here's where it gets really interesting and maybe something for you to think about going forward. Given Core and Maine's stated confidence in leveraging that long-term demand for water infrastructure.
Which seems pretty solid fundamentally.
Right. And given their ongoing plans for greenfield expansion and their strategies to navigate pricing and manage costs, what specific tangible indicators would you look for in their next couple of earnings reports to really validate their story?
Yeah, that's the question. How would you judge if they are truly outperforming the market like they expect to? Especially when you consider the uncertainties out there, like broader economic shifts or maybe prolonged softness in that residential market.
And think about that tension, that interplay between the stable, well-funded municipal market and the more volatile residential side. How might noticeable shifts in either one of those areas impact a company with Core and Maine's specific business mix going forward?
What would that signal? Not just about their business, perhaps, but potentially about the wider economic environment, maybe the pace of infrastructure investment overall.
Lots to chew on there. Keep digging, keep asking questions.
That's the deep dive.